Assalamualaikum and good day to our lecturer, Sir Faris. We are group number 1 and today we will present our presentation titled Financial Analysis of Consumer Products and Services Industries. Before we start, let me introduce myself and our team members. My name is Muhammad Fikri and our team members is Muhammad Shazwan, Muhammad Ashraf, Muhammad Harith Aldani, Wan Suhaila and Nur Shazwani. In this presentation, we will analyze on financial performance of 5 companies in consumer products and service industries. The company that we had chose is Spritzer, Dutch Lady, Hapseng, Farmfresh, and Ajinomoto. We will examine their financial statement, evaluate their key financial ratio, compare their financial performance, and provide recommendation based on their efficiency, leverage, and cash flow, and overall financial position.
Today I will be presenting the introduction of our financial analysis report. This report analyzes the financial performance and industry position of 5 food and beverage companies in Malaysia for the financial year 2025. The 5 selected companies are Spritzer, Dutch Lady, Hapseng, Ajinomoto and Farmfresh. The purpose of the analysis is to evaluate each company financial strength, operation efficiency, and on overall business performance. We also compare their performance with the current economic condition and the food beverage industry in Malaysia. This report is divided into 6 main sections. Number 1 is the industry background. Number 2 is economic background. Number 3, company background. Number 4, performance analysis. Number 5 is strategy evaluation, cooperation, education making. Okay, so what does this report cover? First, the industry background provide an overview of the food and beverage industry, including the current trends, market competition, and the major factors affecting the industry. Second, the economic background discuss Malaysia economic condition in 2025 and 2026, such as inflation, interest rate, economic growth. This factor has a significant impact of business performance. Next, the company background introduced is a selected company by explaining its business activity, market positions, and business strategy. Finally, the performance analysis evaluates each company financial performance using the financial ratio and other relevant performance indicators. Purpose of this report. The main purpose of the report is to understand how economy and industry factor influence the financial performance of the selected company. In addition, these reports help us to understand the current industry environment, assess the financial health of each company, compare the companies using financial ratio and statistical analysis, and support better business and investment decisions.
Now, we will take a look on industry background. Under the Bursa Malaysia classification, the food and beverage industry sit within the consumer product and service main market. It functions as a classic defensive sector. Unlike cyclic industries such as property and technology, which are highly sensitive to economic downturn, the F&B sectors enjoy resilient, stable demand. Because food and beverage are fundamental everyday necessities, consumer spendings remain steady regardless of microeconomic fluctuation, providing a high reliability baseline of revenue generation. This industry is split into 2 distinct operational models, each of them carrying a unique spending patterns and profit margins. The first one is fast-moving consumer goods or package manufacturer such as Nestle Malaysia, Farmfresh, and Dutch Lady. Operating primarily in a B2B models, they manage massive supply chains and sell to supermarkets. Their financial performance is heavily tied to global commodity price like sugar, milks, and cocoas. Second are the food service operation and chains, including Secret Recipe, Berjaya Foods, which runs Starbucks, and the new in the markets like Oriental Coffees. These operate a direct-to-consumer, also known as B2C models. Their financial health is highly sensitive to labor costs, retails, rentals, shifting consumer preference, and localized disposable income. Now, we will take a look for critical micro and macro forces directly impact the financial statement of Malaysian F&B companies. The first one is halal certification. Securing JAKIM Halal certification is a vital business driver rather than just a legal compliance requirement. Fundamentally, shipping, operational costs, and inventory management. Second, margin pressure. Recent volatility in raw material costs and currency values require a strict monitoring of the cost of goods sold to evaluate how effectively companies protect their margins. The third one is digitalizations. The boom in the food delivery platform and Grab and Go service has fundamentally altered corporate spendings, driving capital into cloud kitchen and lean digital models. And the last one, the local shift. A growing consumer preference from homegrown local brands over international corporations is actively redirecting market share and driving revenue changes across the industry.
Hello, my name is Muhammad Harid Aldani Ismail. So now let's moving on to the economic background. Between 2025 and 2026, Malaysia's economy showed strong resilience and growth, driven by solid domestic demand and government initiative under the Madani Economy Framework. This macroeconomic environment directly impacts the fast-moving consumer goods, FMCG, and food and beverage sectors in three key ways. First, consistent demand. Food and drinks are everyday essentials, keeping the FMCG sector robust even during moderate economic periods. Second, consumer confidence. With low unemployment rates between 3.2% to 3.3%, consumer sentiment remains highly optimistic. Third, borrowing costs. Bank Negara Malaysia maintaining the OPR at 3% keeps borrowing expenses consistent, allowing firms to effectively manage their operations with unexpected high interest costs. Looking at our children companies, Spritzer, Ajinomoto, Dutch Lady, Hapseng and Farmfresh, they are significantly influenced by these conditions. A steady GDP increase of 4% to 5% improves household earnings, directly benefiting major consumer brands. However, global raw material price fluctuations such as milk powder, sugar and wheat still require cautions. Companies like Farmfresh and Dutch Lady must carefully balance their pricing strategies to keep products affordable for the Malaysian market while maintaining corporate profitability.
Next, 4.0 Company background. There are several consumer product and service industry. First of all, Spritzer. Spritzer is one of the leading bottled water companies in Malaysia. The company makes bottled water, mineral water, sparkling water, and flavored drinks. It has 3 water plants and 1 packaging factory in Malaysia. Spritzer sells its product in Malaysia and many other countries. Spritzer has 40% of the market share and has been trusted by customers for more than 35 years. The company focuses on quality, health, and protecting the environment. Spritzer's main business includes manufacturing, trading, and other business activities. In the future, Spritzer plans to introduce more products, remain the market leader, support sustainability, and become a strong health and lifestyle brand. Second, Dutch Lady Malaysia. Dutch Lady Malaysia is of the leading dairy companies in Malaysia. With more than 60 years of experience, the company produces and sells a wide range of dairy products including fresh milk, UHT milk, powdered milk, yogurt, and ready-to-drink beverage for people to all age. Dutch Lady works closely with local drink farmers to improve milk quality and increase fresh milk production. The company has built a strong market position through high-quality nutrition products, continuous innovation through and a wide distribution network across the country. It means business focus on dairy product marketing and distribution. In the future, Dutch Lady aims to expand product innovation, strengthen customer engagement through digital platform, maintain its market leadership, support sustainable business practice, and improve manufacturing efficiency. Third, Hapseng is one of the well-known food and beverage company in Malaysia. The company has more than 60 years of experience in making quality food products. Hapseng produces more types of products such as biscuits, crackers, cookies, snacks, instant coffee, and drinks products. These products are popular because they are tasty, affordable, and made with good quality ingredients. Customers can easily buy Hapseng's products in supermarkets, convenience stores, and other retail shops across Malaysia. The company has exported its product to more than 60 countries, which helps Hapseng become known around the world. To stay competitive, Hapseng continues to introduce new products that meet customer needs and preference. The company also improved its product process by using better technology to make products more efficiently while maintaining high quality. In addition, Hapseng is expanding its business by increasing online sales, strengthening its brand name, and growing its national markets. The company also supports sustainable business practice by reducing waste, using resources wisely, and focusing on long-term business growth. These efforts help Hapseng continue to provide high-quality product and satisfy customers both in Malaysia and internationally. Number 4, Ajinomoto. Ajinomoto is a well-known food company that makes seasonings and food products. The company produces products such as MSG seasonings, frozen foods, and health and nutrition products for family and food businesses. Ajinomoto is one of the leading seasoning brands in Malaysia and is trusted by many customers because of its good quality and great taste. The company is known for improving the flavor of food and helping people prepare delicious meals easily. To continue growing, Ajinomoto develops healthier food products, creates new products to meet customer needs, and improve its manufacturing process. The company also uses digital marketing to reach more customers and support sustainable business practice to protect the environment and achieve long-term growth. Last but not least, number 5 is FarmFresh. FarmFresh is one of the leading dairy companies in Malaysia. The company produces fresh milk, yogurt, cheese, and plant-based drinks such as soy and oat milk. FarmFresh follows a grass-to-glass system, which means it manages every step from dairy farming, milk collection, processing, packaging, and delivery. This helps ensure that all products are fresh, safe, and of high quality. The company has a strong distribution network that supplies products to supermarkets, schools, restaurants, and online stores across Malaysia. FarmFresh continues to grow by introducing new products, expanding into the markets, and improving its service. Its service main goal to provide healthy, fresh, and available products while focusing on innovation, operational excellence, sustainable, and customer certification.
Assalamualaikum and hello to sir. My name is Muhammad Shazwan bin Hamdan. So today, I will present the performance analysis of 5 selected company for the financial year 2035, which are Hapseng Company, Dutch Lady, Spritzer, FarmFresh, and Ajinomoto. This analysis focuses on efficiency ratio and leverage ratio by comparing each company with the industry average. Let's start for efficiency ratio. For total asset turnover, TATO, the industry average is 1.04 times. Hapseng Company record the highest TATO at 1.58 times, followed by Dutch Lady at 1.39 times. Both company above the industry average, showing efficient asset utilization. Meanwhile, Spritzer at 0.80 times, FarmFresh at 0.75 times, and Ajinomoto 0.66 times were below the benchmark, indicating lower efficiency. For fixed asset turnover, FATO, the industry average is 2.35 times. Hapseng Company achieved the highest ratio at 4.68 times, followed by Dutch Lady at 2.40 times, showing better use of fixed asset. However, FarmFresh 1.95 times, Ajinomoto 1.50 times, and Spritzer 1.21 times were below the industry average. Next, leverage ratio. For debt ratio, the industry average is 33.28%. Dutch Lady record the highest ratio at 47.23%, followed by FarmFresh at 46.10%, indicating higher reliance on debt financing. Hapseng record 34.46%, slightly above the benchmark, while Spritzer 23.77% and Ajinomoto 15.85% were below the industry average, showing lower financial risk. For debt to equity ratio, the industry average is 55.07%. Dash Lady 89.51% and Farmfresh 85.54% were above the benchmark, indicating higher debt dependence. Meanwhile, Hapseng 50.29%, Spritzer 31.70% and Ajinomoto 80.84% were below the industry average, reflecting stronger equity position. In conclusion, Hapseng showed the strongest efficiency performance with both Tato and Fato above the industry average. Meanwhile, Dash Lady and Farmfresh had higher leverage, showing greater dependence on debt financing, while Spritzer and Ajinomoto maintained a more conservative financial structure with lower leverage. Next, I will present the DuPont ROE analysis and market value ratio. This analysis evaluates profitability performance using the DuPont model and market performance based on EPS and DPS. DuPont ROE analysis. Based on the chart, Hapseng record the highest ROE at 30.30%, followed by Dash Lady at 19.22%, Farmfresh at 15.80%, Spritzer at 14.58%, and Ajinomoto at 5.70%. This showed that Hapseng generate the highest return from shareholder equity. For ROA, Hapseng also record the highest ratio at 19.94%, followed by Spritzer 11.05%, Dash Lady 9.56%, Farmfresh 8.21%, and Ajinomoto 4.79%. This indicates that Hapseng was the most efficient in utilizing asset to generate profit. Next, the market value ratio. The market value ratio evaluates earning per share and dividend per share (DPS). For EPS, Dash Lady record the highest EPS, increasing from 151% in 2024 to 161.4% in 2025, showing stronger profitability. Spritzer also improved from 11.2 cent to 14.3 cent, while Farmfresh increased from 3.40 cent to 5.68 cent. However, Hapseng EPS decreased from 7.2 cent to 6.2 cent, and Ajinomoto record a significant decline from 660.25 cent to 81.69 cent, indicating lower earning per share. For DPS, Dash Lady maintained the highest dividend at 35 cent for both years, showing stable return to shareholder. Spritzer increased from 4.0 cent to 5.0 cent, while Hapseng decreased from 7.0 cent to 4.0 cent. Ajinomoto record a significant increase in DPS from 9.1 cent to 250.40 cent despite its EPS decline. Meanwhile, Farmfresh slightly decreased from 1.2 cent to 1.0 cent. In conclusion, Hapseng showed the strongest profitability performance with the highest ROE and ROE. For market value performance, Dash Lady demonstrated strong and consistent shareholder return through high EPS and stable dividend, while Ajinomoto provide higher dividend returns despite lower EPS performance. Next, I will present the financial performance analysis for all companies, starting with Spritzer Company. Based on Fato and Tato, Spritzer was less efficient in utilizing its asset compared to the industry average. Order revenue increased from 578.988 million in 2024 to 656.854 million in 2025. Higher investment in PPE and total asset caused Fato and Tato to record only 1.21 times and 0.8 times respectively, which were below the industry average. However, Spritzer maintained strong profitability with a DuPont ROE of 14.58%, supported by a net profit margin of 13.81%. EPS increased from 11.2 cent to 14.3 cent, while DPS increased from 4.0 cent to 5.0 cent, showing improved shareholder return. In terms of financial risk, Spritzer remained low risk as a liability decreased from 34.62% to 23.77%. The debt ratio is 23.77% and debt to equity ratio is 31.17%, were below the industry average, indicating lower dependence on debts. Overall, Spritzer remained profitability with a low risk financial position, although its asset efficiency was below the industry average. Next is Dash Lady. Dash Lady show a strong asset efficiency with a Fato of 2.40 times and Tato of 1.39 times, both above the industry average. Revenue also increased from 1,445.071 million in 2024 to 1,500.357 million in 2025, indicating effective asset utilization. This performance support a DuPont ROE of 19.22% with a net profit margin of 6.88%. EPS increased from 151.0 cent to 161.4 cent, while DPS remains stable at 35 cent, reflecting consistent shareholder return. However, Dash Lady record higher financial risk with a debt ratio of 47.23% and debt to equity ratio of 89.51%, both above industry average. This was mainly due to higher reliance on the short-term borrowing, which increased from 1.059 million to 90.634 million. Overall, Dash Lady demonstrates strong efficiency and profitability, but its higher debt level indicates greater financial risk. Next is Hapseng Company. Based on Fato and Tato, Hapseng Company was highly efficient in utilizing its asset compared to the industry average. Revenue remains stable at 394.670 million, while Fato and Tato record 4.68 times and 1.58 times, both above the industry average. This strong efficiency contribute to a DuPont ROE of 30.30%, supported by a net profit margin of 12.62% and financial leverage of 1.52 times. In terms of debt, total liability decreased to 33.46%, while equity increased to 165.613 million. The debt ratio was 33.46% and the debt to equity ratio was 50.29%, indicating a balanced financial position. Overall, Hapseng demonstrate excellent asset efficiency, strong profitability and balanced financing. Next is Ajinomoto Company. Based on Fato and Tato, Ajinomoto Company was less efficient in utilizing its asset than the industry average. Although revenue increased from 636.446 million to 684.504 million, Fato and Tato were 1.50 times and 0.66 times below than industry average. This result in a DuPont ROE of 5.70%, supported by a net profit margin of 7.26% and financial leverage of 1.19 times. EPS fell from 670.35 cents to 81.69 cents, while DPS increased. However, the company maintains strong financial stability by fully repaying short-term borrowing. The debt ratio was 15.85% and the debt to equity ratio was 18.84%, both below the industry average. Overall, Ajinomoto Company had strong financial stability but weaker asset efficiency and profitability. And lastly, Farm Fresh Company. Based on the Fato and Tato, Farm Fresh Company was less efficient in utilizing its asset than the industry average. Revenue increased from 810.411 million to 981.181 million, but Fato and Tato were only 1.95 times and 0.75 times due to higher investment activity. This contribute to a DuPont ROE of 15.80%, supported by a net profit margin of 10.94%. EPS increased from 3.40 cents to 5.68 cents, while DPS decreased slightly from 1.2 cents to 1.00 cents. Liability also increased, with the put option liability rising from 36.955 million to 55.833 million, and long-term loan from 67.648 million to 91.622 million. The debt ratio was 46.10% and the debt to equity ratio was 85.54%, both above the industry average. Overall, Farm Fresh shows strong growth but lower asset efficiency and higher financial risk. That's all for my parts. Thank you.
Good morning, everyone. My name is Wan Suhaila. For this session, I will be presenting the cash flow analysis of 5 companies, namely Dash Lady Industry Berhad, Farm Fresh Berhad, Spritzer Berhad, Ajinomoto Malaysia Berhad, and Hapseng Industry Berhad for the financial year 2025. First, let's look at the operating activities. All 5 companies generate positive operating cash flows, indicating that their core business operations were able to generate sufficient cash continuity. Among the 5 companies, Dash Lady recorded the highest operating cash flow of RM 159.48 million, followed closely by Farm Fresh at RM 156.14 million and Spritzer at RM 153.71 million. Meanwhile, Ajinomoto and Hapseng reported a lower operating cash flows of RM 69.55 million and RM 52.51 million respectively. These positive cash flows were mainly supported by profits earned during the year, together with non-cash expenses such as depreciation and amortization. Changes in working capital items including inventories, receivables, payables, and tax payments also influenced the operating cash flow position. The key takeaway is that all companies demonstrated strong operational performance and generated sufficient cash from their normal business activities. Moving on to investing activities, among the 5 companies, Ajinomoto was the only company that recorded a positive investing cash flow amounting up to RM 94.1 million. This was mainly due to proceeds received from investment sales and investment income. In contrast, Dash Lady, Farm Fresh, and Spritzer, and also Hapseng recorded negative investing cash flows. The major reason was their significant investments in property, plants and equipment, biological assets, and other long-term assets. These investments suggest that the companies are expanding their operations and investing for future growth. Therefore, the negative investment cash flows should be viewed as a strategic growth decision rather than a sign of poor performance. Next, regarding financing activities, all 5 companies recorded negative financing cash flows. The largest financing cash outflow was reported by Ajinomoto at $212.4 million. The financing outflows were mainly caused by dividend payments, repayments of borrowings, lease payments, and financing costs. In particular, dividend payments represented a major contributor to cash outflows across all companies. This shows that the companies used cash generated from operations to fulfill financial obligations and return value to shareholders. Finally, looking at the net cash flow position, Dutch Lady, FarmFresh, Spritzer, and Hapsan recorded positive net cash flows during the year. Dutch Lady achieved the highest increase in cash and cash equivalent of RM44.8 million, followed by Spritzer at RM32 million. However, Ajinomoto recorded a decrease in cash and cash equivalents of RM48.8 million, largely due to substantial financial cash outflows from dividend payments and loan repayments. Overall, strong operating cash flows enable most companies to increase their cash balance, while Ajinomoto experienced a reduction in cash due to its heavy financial commitments. Based on the cash flow analysis, 4 key findings can be identified. The first finding is stronger operating cash flow generation. Dutch Lady, FarmFresh, and Spritzer recorded the highest operating cash flows among the 5 companies. This indicates strong business performance, efficient operations, and the ability to generate cash internally without relying heavily on external funding. The second finding is aggressive investment and expansion activities. Dutch Lady, FarmFresh, and Spritzer recorded significant cash outflows from investing activities, mainly for investment in property, plants, and equipment, as well as other long-term assets. This investment reflects management's commitment to business expansion, operational efficiency, and future growth opportunity. The third finding is higher dependency on external financing. Ajinomoto showed the highest financial cash outflow among all companies. A substantial portion of the outflow was attributable to dividend payments and payments of Islamic financial facilities. Similarly, FarmFresh also utilized some external financing sources, including super financing and share issuance, to support its growth strategy. The fourth finding is potential liquidity pressure. Although Ajinomoto generated positive operational cash flow, the company experienced a decline in cash and cash equivalents due to large financing cash outflows. This suggests greater liquidity pressure compared to the other companies, which generally maintained positive cash balance. In conclusion, Dutch Lady, FarmFresh, and Spritzer demonstrated the strongest overall cash flow performance, supported by robust operational cash flows and investment activities for future growth. Ajinomoto relied more heavily on financing activities and faced the highest liquidity pressure, while Hapsan maintained a relatively stable cash flow position through the year. Now, let us examine the position of each company based on the product lifecycle model using the cash flow patterns. Starting with the introduction stage, none of the companies fall under this category. All 5 companies have established market positions, recognized brands, and positive operating cash flows. Therefore, they have clearly progressed beyond the market entry stage. Moving to the growth stage, FarmFresh is specified in this category. FarmFresh recorded strong operating cash flow, significant investments in property, plants, and equipment, as well as biological assets, and also utilized external financing sources to support expansion. These characteristics are consistent with companies experiencing rapid growth and increasing market presence. Next is the maturity stage, which includes Dutch Lady, Spritzer, Hapsan, and Ajinomoto. For Dutch Lady, strong operating cash flow, stable profitability, and consistent dividend payments indicate a mature and well-established business. Similarly, Spritzer demonstrates characteristics of mentioned company through its strong cash generation and stable market position. Hapsan also falls under the maturity stage due to its positive operating cash flow and regular dividend distributions, indicating a focus on maintaining its market presence rather than pursuing aggressive expansion. Ajinomoto is also classified as a major company because of strong operating cash flows and substantial dividend payments. However, the decline in its cash balance suggests that the company faces high liquidity pressure compared to other major firms. Finally, under the decline stage, none of the companies are classified in this category. All companies generate positive operating cash flows and showed no significant signs of deteriorating business performance. To conclude, FarmFresh is currently positioned in the growth stage, while Dutch Lady, Spritzer, Hapsan, and Ajinomoto are in the mature stage. No company falls under either the deterioration or decline stage, indicating that all 5 companies remain financially stable and continue to generate positive cash flows from their operations. Thank you.
Now I will present the strategic evaluation and corporate decision making. In this section, we evaluate the financial performance of the 5 selected companies using 3 key indicators. Number 1 is the efficiency ratio, leverage ratio, and net cash flow. Okay, based on this result, we identify which company is more suitable for joint venture. Okay, Hapseng. So first, Hapseng is the most suitable company in the high efficiency ratio, which means the user is asset effectively to generate revenue. It also has a positive net cash flow, showing that company generate enough cash for its operation. Overall, Hapseng has strong financial performance and is the best choice for the strategic partnership. Next is the Dutch Lady, which is also considered a suitable company. The company has a high operation efficiency and positive net cash flow, indicating the strong financial performance. However, its leverage ratio is such that it could improve in long-term debt management. Okay, Spitzer is also classified as suitable, although its efficiency ratio are weaker than Hapseng and Dutch Lady. It has good debt repayment capability and positive net cash flow. This shows that the company remains financially stable. Moving on, the Ajinomoto is considered the less suitable company. The main reason is the negative net cash flow, which may indicate cash flow management problem. Even the total leverage ratio is acceptable, its overall the financial position is weaker. Finally, the Fund 5 is also categorized as the less suitable companies. The company has a weak efficiency, weak leverage performance, and face challenge in managing its asset and repaying long-term debts. These factors reduce in financial strength. Explain the what Hapseng is recommended as the best company for a joint venture. After evaluating the 5 companies using their efficiency ratio, leverage ratio, net cash flow, and product life cycle, we have found that Hapseng has the stronger overall financial performance. First, the efficiency ratio. Hapseng has used its asset efficiently to generate sale. Its fixed asset turnover is 4.8 times, and its total asset turnover is 1.58 times, both of which are the highest than industry average. This means company is able to utilize its asset effectively to generate more revenue, showing the strong operational efficiency. Next, the leverage ratio. Hapseng also had a stable financial position, although the debt ratio of 33.46% is slightly higher than the industry average. Its debt to equity ratio of 50.29% is lower than in the industry average. This indicates that the company maintain a balanced capital structure and manage in long-term debt responsible. Moving on the net cash flow, Hapseng has a positive net cash flow, meaning it receives more cash that is spent. This is important because positive cash flow allows the company to finance its daily operation, invest in the future growth, and meet the financial obligation without difficulty. Finally, the product life cycle. Hapseng is currently in the maturity state of the product life cycle. At this stage, the company has a stable sale, a strong market position, and consistent profitability. This made the Hapseng the available and low-risk business partner for a long-term joint venture. In conclusion, I recommended Hapseng as the most suitable company for a joint venture. This recommendation is based on the 4 main trends: efficient asset utilization, balanced debt management, positive net cash flow, and a stable position in the maturity state of the product life cycle. This trend demonstrates that Hapseng has strong financial performance and excellent potential for long-term business cooperation. Okay, thank you. That is the end of my presentation.
Our first concern is Farm Fresh low asset efficiency. Even though they have invested heavily in state-of-the-art dairy farms, livestock, and cold storage, their asset turnover ratios are very low. A total of 0.75 means they struggle to turn their massive infrastructure investment into quick sales. For an MNC partner looking for rapid, scalable growth, this is a major operational hurdle because too much capital gets locked up in slow-yielding assets. Secondly, we need to look at where Farm Fresh stands in its business life cycle. Unlike mature competitors like Dutch Lady, which enjoy stable, self-sustaining cash flows, Farm Fresh is still in a highly volatile growth stage. This means they are cash hungry and rely heavily on external debt markets, such as Sukuk programs and bank borrowings, to fund their operations. A foreign investor typically looks for immediate capital stability rather than a partner that depends on continuous debt to survive. Thirdly, Farm Fresh leverage metrics are quite alarming. Their total liabilities have jumped to over RM622 million, making up over 46% of their entire capital structure. This leaves them with a debt to equity ratio of over 85%, which is much higher and riskier than the safe industry benchmark of 55%. This heavy debt burden leaves the company highly vulnerable to external economic shocks, rising interest rates and fluctuating raw material costs. Fourthly, there is a severe cash flow bottleneck. Although Farm Fresh successfully generate a strong operational cash flow of over RM156 million, almost all of it was swallowed up. They spent over RM83 million on heavy capital expenditures and another RM67 million on servicing debt and paying dividends. Consequently, they were left with a critically low net cash increase of only RM618,000 for the entire financial year, leaving very little buffer for new strategic initiative. Lastly, looking at the numbers, Farm Fresh has a critically tight liquidity runway with a cash balance of just RM618,000, while its ROE appears high at 15.18%. This return is artificially inflated by heavy debt rather than true profitability. Therefore, due to low asset efficiency and high leverage, Farm Fresh is the least attractive partner for a foreign MNC seeking stability. Thank you so much.
To conclude, each of company has its own strengths and weaknesses in terms of efficiency, leverage, and cash flow performance. Among these 5 companies, Hub Seng show the strongest overall performance with efficient asset utilization, positive cash flow, and stable financial position. Although Dutch Lady and Spritzer also perform well, Dutch Lady has higher financial risk due to its leverage, while Spritzer asset efficiency is lower than industrial leaders. Farm Fresh and Ajinomoto still face some challenge in efficiency and financial performance. Therefore, based on our analysis, Hub Seng is the most suitable company for joint venture because it offers the best balance of profitability, efficiency, and financial stability. Thank you.